Hello, traders, investors. Welcome to the weekly report of Exo Capital. I'm Roman Kaider, and I'll be presenting this week results. We had a very interesting week. Let's right now jump into our trading view screen. We've seen an interesting hike on the S&P. The dollars have taken quite a hit because of these week results mainly. So let's jump into it right now. But firstly, we should have a look to this week numbers. So if you remember, last Saturday I was mentioning this week's CPI's numbers. They came out with 0.2% on the monthly basis. We were waiting a 0.3%, so we are 1 point lower, 10 points lower than that. Same on the CPI, 3%. We were expecting 3.1%. So that's quite bullish, meaning that the FOMC, the Fed, if we can say, is getting results about their policy that is trying to get this number back to 2%, which is their target, if we remember well. About this Friday, yesterday, we had the consumer sentiment at 72. We were waiting 65, so we are a bit higher than that. It's a bit contradictory with last CPI's number, but that's what we got, and we will be waiting next week numbers on the core retail sales and the retail sales to have a better understanding of what's going on. But still, I was a bit surprised by this number. We could have been higher than the forecast, and it would have been for sure different, because Powell would have to be more strict, if I can say, in order to complete their target, which is to get back to 2%. So what I was saying, basically, very interesting week. The markets had a lot of movements. We're gonna have a look in details to the charts today. That will be our special focus on the S&P that has a great hike, and the dollars that was hit by those numbers. About the FOMC, not next week, the week after, 11 days from now, we are still at the same probability than past week. We are at 93%. What is interesting is that we've been increasing at 97% yesterday, so the 14th of July, but still at the same number than last week. So nothing very rare, nothing new here. We are still at 93% of a rate hike for next FOMC. That will be in 11 days, the 26th of July. About September rates, let's have a look what the probability says, because right now we are 83%. That's 10 points higher, even 13 points higher than next week. So we're kind of finding a trend here. The market is looking at same current same rate than the next hike. So in the 26th of July, we're gonna hike, and the probability says that Powell will stay at the same rate for the next FOMC on the 20th of September. That would be actually 525 to 550. So if you remember, now we are here. You can see current. That will mean the same rates than next FOMC hike. Well, we'll see that next week, but I'm pretty sure we're gonna have the same results, and it seems interesting. Next week we'll have a look to all FOMC of this last semester. I'm talking about the FOMC on the 1st November and the one in December. But today we're gonna focus on the markets, not on the rate hikes. So like I was saying past week, I wanted to talk about United States bankruptcies today, but we don't have the results of last quarter, the Q2. So we will wait Q2 numbers before jumping into something more in details. Let's just have a quick look to what I was thinking. This is basically the United States bankruptcies from before 2000 until today, and what we're gonna see next week is why we could have a potential financial crisis first semester 2024. You can see before the crisis of 29. So if you remember, looking at the S&P, we got a low Q1 2009. So Q1 2009 and 2007, 2008, we've seen the bottom actually of United States bankruptcies. So it actually skyrocketed after of course the market crash, because the companies take the consequences of the market crash. So if we look at the trends, we can see kind of a normal trend before, then the bankruptcies go down, and after the market crisis we can see the boom in bankruptcies. So if we just try to think with the same market trends, we will see here the kind of same trend than here, and here kind of a bottom on US bankruptcies, like we've seen in 2007 and 2008. Does this mean that 2024 will be the 29 of past financial crisis? Well, the future will say. I'm not saying in the future, of course, but that's what we will be focusing on next week. This week I wanted to do it, but the markets are very interesting, and we should rather focus on those numbers. So we're gonna start basically with the S&P. Like I was saying past week, if you remember, we had a correction of previous week. That was quite bullish. So in the last 3 weeks, if we take the last 3 weeks, we're gonna see a pretty huge increase of with yesterday closing. We are at 3.7% hike in the S&P market since 3 weeks. So that's very interesting. Last week we were mentioning a kind of correction of 2 weeks ago, where we've been at a 50% correction of the previous week, and we were kind of on a resistance here that is related mainly to the 50% of this shorting zone. If we take the Fibonacci from last top to last bottom, so here it's kind of the middle of this zone. So it was kind of a resistance, and we actually broke it. We are now way above it and going to the next resistance. This will be our support. So next target would be here. Why? Because you can see here we stopped around these numbers, and that's definitely a zone that will be interesting, because it will be quite just above our shorting loading zone, and still in the last in April 2022 last high. We are still in the highest point since more than 1 year, since March 2022. We'll see if we can reach last highs of January 2022, but we are definitely in a interesting zone at the moment. What I want to insist on and focus on is the RSI, because we are seeing something interesting here. Let me just increase so you can see better. We can see that the high 2 weeks ago here had a RSI lower than this previous week. So that's not very bullish. We can see now the same thing, where the RSI seems to go higher than last 2 weeks ago high, but we want to see what it says next week, because if we have a correction next week with a low here, maybe not lower than what we've seen this week or last week, but if the RSI comes lower with not a lower on the points, that would be definitely bearish, and maybe we could start our shorts at that time. But let's keep it let's keep it smooth, since we don't know what can happen. But like I was saying, we should prepare our shorts, maybe getting some options on this. But we'll have a talk about all of this later on those weeks. That's what mainly I wanted to talk about. But we need to look at other charts for sure. So we're gonna just have a quick look to the DXY, the dollar. This week was a crush for the dollar. It lost around 2.3%. So that's a big drop. The last time we've seen that kind of drop was in November 2022. So we are now lower than our previous low in July. In April 2023. So we are in new zones. Our new target will be this point. That would be the start of the buying zone for the dollar. That will be if we put something a rectangle to understand, our buying zone of the dollar will be here. So between 98 and 95, basically. So let's see what we're gonna have in these next weeks, because if the dollar is still weakening, that's definitely something we could see. All right. Last chart I wanted you to know, and which is very important, of course, the US government bonds on a 10-year yield, on a 10-year basis. So what I want you to understand here, I'll be very quick because I don't want this video to be too long once again, but let's have a just simple math, all right? We can see the hike. It doesn't seem that impressive, but it is something we've never seen in past history. So why am I saying that? All right, let's look at that hike here in the 70s. That was quite a big hike. So we take the lower up to the top, and we are 32% hike during 58 months. Okay, so that was the kind of biggest hike we've seen in the rates. So if you remember, that was 130% for 58 months. Okay, so now let's have a look to nowadays what it says. Let's take the bottom and let's take the high. We are in 40 months at 620% hike. That's something we've never seen. All right, going from 0.5 up to 4%, even higher, it's a 600% hike. Even if here we've been from 5% to 13% in terms of percentage change, it's completely different than what we are saying nowadays. You can see this hike have never been seen in the recent history, and even in all histories since the Second World War, since actually we started the Fed. So we should focus on that. That's something very important. We're gonna have a look to these charts more, and I truly want you to understand this. It is related to the inverted yields we've seen the last weeks, the inverted yield charts. If you remember, nowadays the 10-year is less expensive than the 2-year. So basically, what it means that for the government, it costs more to have a loan on a short-term basis than on a long-term basis. which is the inverted yield, because on normal times it's cost most, you pay more on a longer period than on a short period. But I've talked a bit about that during last previous video, so I'm not gonna talk about it once again. So now I think you've understood the situation we have here. So we should definitely look at the next week and in the FOMC S&P numbers. We'll see what they have to say, and when we will get United States bankruptcies numbers, we'll jump into this. For me, it will be the end. I will wrap up that video for today and wish you an amazing trading week and a safe trading for next week trading. Bye bye. That's a lot of trading though. Bye bye.